Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 27th of April, as we record. It's been another exciting week full of new company information and new developments for us to assess, and that's exactly what we'll be doing today. We are going to start with this week's US tech earnings, Alphabet, Meta, and Microsoft, and we'll discuss the CMA's blocking of Microsoft's $75 billion deal for video games maker Activision Blizzard as well. And we'll touch on our cover story this week, which is on big tech's AI prospects. Then we're going to look at interim figures from vehicle testing equipment, manufacturer AB Dynamics, and we'll conclude with a discussion of London Stock Exchange, one of the many companies reporting trading updates today. Joining me to discuss all of this over the line are Mark Robinson. Hi, Mark.
Hi, Dan.
Julian Hofmann.
Hello, Dan.
And in the studio, we have Mike Fahy.
Hello.
And Arthur Sants. Hi, Arthur.
Hey, Dan.
Arthur, we will start with you because we're going to start with technology. Alphabet and Microsoft figures, first of all. Q1 results out earlier this week. And they staved off some investor fears, specifically of advertising slowdown and moderation in cloud computing growth.
So Alphabet and Microsoft were the first two out on Tuesday, and there's concerns with Alphabet around advertising. In recessions, advertising is always sort of said to be the first cost that is cut from companies. And last year, there was a slowdown in advertising. But Meta shareholders will be pleased that advertising revenue from Alphabet increased 1.9% year on year in the quarter, which was ahead of analyst expectations. Meanwhile, Meta, which reported on Wednesday, also saw its revenue go up 3%, which is largely driven by advertising. So in general, advertising hasn't performed as badly as people were expecting, which has pushed up these companies' share prices. The sort of reasons that I've heard was sort of advertising budgets have been cut by companies, but it means that actually they're giving more of their money to the big advertising companies because they want it to sort of be safe on their returns. And Google, Meta have historically really high returns on advertising. Mm-hmm. So although they might be cutting their budgets elsewhere, this sort of means maybe a bit more is going towards these big digital advertisers. Also with digital advertising, the ROI is high, but also it is obvious what the ROI is. If you click on the ad, you can see how successful it is. Whereas an ad on the subway or an ad on TV, you don't actually know what your ROI is on that advertising. So digital advertising, people always said that it might be a bit more resilient than traditional forms of advertising during a recession. And this is actually the first time we've had. Well, in the US, we haven't actually gone through a recession yet, but everyone keeps saying we maybe are or going into one.
Or in the UK, but but obviously that is the concern.
But this is sort of the first time that digital advertising has been the dominant form. And so far, I guess it's holding up wellish, obviously relative to pre-pandemic when these companies were growing at 20%, 1% and 3% is not crazy, but it's better than last year when Meta across the year, its revenues went down 1%. So it's heading in the right direction for them, and Google was similar. So for both of those, it was surprisingly positive on the advertising front.
Yeah. Speaking of things growing at 20%, the cloud side obviously is still growing very quickly, but there were some concerns last year when the likes of Microsoft reported a reduction in growth rates for cloud computing. But again, these figures slightly ahead of expectations, slowdown in that growth rate, which is still very high, was not quite as not as bad as people thought, or not bad at all, really.
Yeah, so I think for Alphabet, Google Cloud, it was 28%, and then for Azure, which is Microsoft's cloud computing, it was 30% growth, which is still insanely impressive. Yeah. It's down from higher rates, and the way it works is that companies pay on a consumption basis. So if you're a customer for Azure, you'll pay for how much computing you need rather than a fixed contract. So when these companies are trying to cut costs, they might just sort of scale back their cloud consumption, which is why the growth rates have come off like 40, 50% that they used to be, down to 30%. But at the same time, the growth rates can also pick up again if companies decide to increase their consumption. These figures were both slightly ahead of expectations, and that's been good for Amazon. Amazon's AWS is still the largest cloud computing service in the world, followed by Microsoft, followed by Google. And Amazon share price went up off the back of both of Microsoft and Google Cloud's results. So investors were clearly happy to see what their growth rates were and sort of reflected well with Amazon. And then the other interesting thing is that all these companies have been cutting operational costs by firing thousands of employees, but each of them, Google, Microsoft, and actually Meta, which also invests loads in servers, although it doesn't offer its own cloud computing, like it doesn't offer the service to other people, but it uses those computers for its own AI products. All of them have either maintained or increased their capital expenditures. Meta's forecasting around 30 billion of capex. Microsoft last year was in the 20s. Amazon's was in the 60s. For comparison, Saudi Aramco's is like 50 billion. So Amazon's spending more on capital expenditure than the largest oil company in the world. BP was less than all of those companies. So you think of all of these tech companies as being sort of digital businesses, but actually there's just like a huge amount of hardware being bought in the background.
Well, let's talk about AI a little bit, because, as I say, it is our cover story this week that you have written, specifically, again, through the prism of big tech and the opportunity there, because there's no doubt that AI has become something which, in some ways, like a blockchain a few years ago, where you attach the word AI to a share price and it goes soaring. But there is, more to it, needless to say, than there was to blockchain. And big tech is really in on the ground floor with AI. Microsoft, obviously, with ChatGPT, but the other companies we mentioned as well, all of them have got fingers in the pie, as it were, and they've got prospects there. That capital expenditure, for example, is quite interesting. Last year, everyone was, almost laughing at Meta's capex spend because it was being directed towards the metaverse, which people didn't really consider to be a credible future prospect. Now they are potentially redeploying some of that into AI-based, capital growth. That seems a lot more attractive to investors.
Yeah, so all of them have been actually Amazon was the first in terms of investing in computing, followed by Microsoft and Google, and Meta was actually behind the trend a bit on the AI front, and they said that they've been doing a lot of sort of catch-up capital expenditure in terms of acquiring the GPUs, which are the chips that do. Go into more detail in the future, but GPUs are these chips that enable parallel computing, which is what you need to train these AI models like ChatGPT, which was trained on a Microsoft computer and thousands of GPUs. So basically, when they talk about investing in sort of AI, it's basically who can buy the most GPUs, and there's only a limited number of them because they have to get designed by NVIDIA and manufactured by TSMC. So they're all sort of rushing to buy as many of these GPUs as possible. And like Meta thought they were a bit behind the trend, so invested loads last year and investing loads again this year to try and buy as many of these GPUs as possible. Amazon, Microsoft are buying a bunch of them as well from NVIDIA. And then Google has its own parallel computing chips called TPUs, but they're all manufactured basically by TSMC in Taiwan. So they're all just trying to get as many of these parallel computing chips as possible so that they can build various AI models for sort of different things. Meta's AI focus is mostly around engagement, getting people to spend loads of time on their apps. So I think on the results call, Mark Zuckerberg said that using AI had increased engagement with Instagram by 25%. So people were spending 25% more time on Instagram. And rather than looking at your own friends, I don't actually have Instagram, but I used to. But rather than looking at your own friends' stuff on Instagram, they use AI to send you stuff from elsewhere, kind of like TikTok, and work out what is going to keep you most addicted, depending whether you think that's a good thing or a bad thing for society. But for investors, for Meta, it's good to have people spending more time on Instagram. Meta also using the sort of generative AI, the ChatGPT type stuff to lower advertisers' costs. So advertisers can go on the platform, and then it's called Advantage Plus, and then they use AI to write advertising copy, make advertising images. So, but Meta doesn't really care about search, which is what Google and Microsoft are sort of wrestling with each other over, which is introducing these chatbots into their search engines. Microsoft being integrated ChatGPT because they're a big investor in OpenAI, and then Google's got its own chatbot called Bard, which is thinking of integrating into the service as well. So they're sort of Microsoft's going after Google's share of the search market. So they're sort of going head to head in that front.
Because Microsoft is, has got the investment in OpenAI with ChatGPT. It's seen as, the the early winner of this newfound investment prospect. And Google, Bard seems a bit of a disappointment perhaps, but there's more to its AI plans than just that. And the valuations these companies trade at obviously are much more reflective of their core businesses. So in Google's case, advertising, for example, search as well. But its valuation is on a pure PE level slightly below that of Microsoft currently, and maybe some of its AI potential is yet to be recognized and yet to kind of come through.
Yeah, so out of this group, Microsoft now currently trades on the highest valuation in the maybe mid to high 20s in the forward PE. Microsoft doesn't really have that much advertising exposure, as he said, about the core businesses. And in their recent results, they were getting double-digit growth from their enterprise software business. They had sort of double-digit negative growth in the consumer side of the business, and they had the cloud business, which was growing at 30%. I think that enterprise bit of Microsoft's business is where they think AI can be really useful. So with Office products, if you have Excel, Word, PowerPoint, if you could get AI to make PowerPoints for you, like consultants would have all their a bunch of new spare time. Maybe we just need less consultants. But it's the enterprise side is where I think Microsoft thinks they can start generating a lot of returns from AI. Google's similar because they have Google Workspace. Google Workspace has 9 million users, whereas Microsoft Office has 350 million users.
Yeah.
So the sort of comparison on that side is Microsoft is way ahead of Google in enterprise software, which is why it trades on a higher, and justifiably trades on a higher price to earnings ratio. Although Alphabet is way ahead of the game, or was way ahead of the game in AI, and it might seem like they're behind the curve because they didn't launch ChatGPT, which everyone's obsessed with, but they definitely have some really interesting technology going on behind the scenes and a load of computing power to run these models. So saying that this battle or this race has already been decided, it's not even 6 months since December when ChatGPT was launched. So there's still a long way to go, and Google is actually the cheapest out of all the big tech companies at the moment. So it's not a value play, but relative to its competitors, it would be.
As you say, it is very early stage, and the computing power is a big aspect too. That's effectively the moats. Well, there's two moats around these companies. One is the amount of money they can spend on these things, and one is the amount of computing power they already have or have access to. I think Google, Alphabet, I should say, was up, about 4% on these figures, but the gains were trimmed somewhat when it said in the call afterwards that it would increase its capital spending on data center capacity, which is obviously going to be a huge thing, not just for AI, but in general in the years ahead. There's always that need to invest in more capacity, but that should give it a good platform for growth. Before we move on, let's turn to the CMA, the competition inquiry into Microsoft's would-be acquisition of Activision Blizzard. The CMA has blocked that. Effectively looks like that spells potentially the end for the deal. I mean, both Activision and Microsoft have said they would appeal. Activision was quite strong in its comments in response. I mean, you do always get companies when deals are blocked saying the CMA doesn't understand the sector, which may or may not be true. But Activision also said the ruling contradicts the ambitions of the UK to become an attractive country to build tech businesses. And then it went a bit further and said it did a disservice to people like us, the UK populace, who face increasingly dire economic prospects, which was maybe a bit of a needless reminder of the situation, but there we are. But I mean, this deal, Activision shares obviously fell on that. But I suppose the other question really is, what does this deal mean to Microsoft? Should Microsoft be appealing this decision? Is there an argument that they don't need it, or it was done at a different time, as it were?
Well, yeah, it seems that Microsoft came out with some fairly forceful comments of its own, I think, around the deal, which surprised me somewhat. I guess maybe they just have to say it. The share price didn't really react, Microsoft's share price, at least when the deal it was announced that the CMA was going to block it. So investors don't seem to care that much. The deal was a £75 billion deal for Activision Blizzard. It was in January 2022, which was a very different valuation time for us. Also on the back end of a massive boom for gaming during the pandemic. So these gaming companies' valuations are much higher. And I was looking, Activision Blizzard, I think it had just over 7 billion in sales last year, so it's like 10 times sales is what they would be paying for it, whereas EA is currently trading on 5 times its sales, so that's like a double EA's valuation. And should Microsoft really be worrying about gaming at all? Gaming makes up 7% of their total revenue and has been growing slower than the rest. Other than personal computing, it's been growing way slower than the rest of the business. So do they even really need to be spending all this money on it? And actually, this deal being blocked might be a good thing for them. Although they were very speculative point they made was that maybe there's some grand strategy involving OpenAI and using generative AI to massively lower the cost of games development, and if they could sort of merge one of the world's most popular games developers with their own computing power, there might be something more that we can't currently see. But at least on the surface, it definitely doesn't look like a bad thing for Microsoft that this deal is being blocked. Definitely a lot worse for Activision shareholders.
Yeah.
I thought the ruling itself was quite interesting, because I think the CMA cited that there would be less innovation and less choice for gamers. I mean, it's hardly, when you compare this to what's happened in a more strategically important sector, defense, over the last couple of years, we've seen the CMA rubber stamping deals for first Cobham, I think, and then Mega and Ultra Electronics too. And you would think that those particular companies have far more strategic importance where the UK is concerned. But then again, I'm somewhat oblivious to the world of gaming.
Well, I mean, there's been a lot of talk about antitrust, obviously, around tech for a long time now, notwithstanding the potentially relative lack of strategic importance from a UK perspective. But I do think cloud computing seems to be something regulators are a bit concerned about in terms of how that feeds in, how that connects to every other part of the tech universe.
And the government obviously made noises about wanting to establish the UK as a tech hub in Europe. So that may have something to do with it. But it just seemed like an unusual decision for me.
Yeah, I think the main problem is the amount of. It's not that actually only 3% of all games are played on the cloud at the moment. So as a percentage of the gaming market, it's really small. But
just 3%
so cloud gaming is the computing's not done like on your console at home.
Yeah.
It's done in the cloud. So the fear is that Microsoft and Amazon basically have like a semi-duopoly, and they're actually being investigated, I think, by Ofcom at the moment around it, but semi-duopoly of cloud computing in the UK. So if you then start combining with they own the games developers, then they control the IP for the most popular games and all of the computing power that people need to play on. Sony is probably another winner, I guess, out of this, because they're the ones who are really worried about, the owner of PlayStation were worried about Microsoft cutting them off. And their appeal they sent into the CMA, and one part of it, they said a potential situation that could happen is that Microsoft would make the game specifically so they would get right to the last level on the PlayStation and then cease to work at the last level.
That's a conspiracy theory.
Yeah.
Never heard one. Yeah, Activision, creator of the Call of Duty games, of course, which has been a particularly big success on PlayStation in the past. Anyway, it's time to move on to our next segment, a very different kind of company that Mike is here to discuss. AB Dynamics, the AIM favorite or erstwhile favorite. It had interim figures this week.
Figures were quite good as well.
Yeah, and there was a similarity, at least, in that the figures were good here too. It's been quite acquisitive, and one recent acquisition has helped drive some of that growth in the half year.
Revenue for the half year period was up about 30% to 50 million-ish, but that was largely driven by, although track testing is the biggest side of the business, and this is a business that does all kinds of testing for new cars, whether that's on track or whether it's in simulators. And it was the simulator side of the business that grew much more quickly. It pretty much doubled its revenue to about 15 million. And that was largely due to its most recent acquisition, which is a company called Ansible Motion.
I'm thinking back maybe to your piece for a few weeks ago about buy and build companies, and and it is perhaps in that mold, albeit the track record, no pun intended, it's not the biggest company yet. It's been around for several decades now, but perhaps it's trying to cast itself as one of those kind of companies. It's got a bit of cash on the balance sheet still as well now, so there might be more acquisitions.
Yeah, so I mean, this deal for Ansible, and Ansible's a company that has what they call driver-in-the-loop systems, which is where a driver sits in a car in front of a massive simulator, and they test new models just to show maybe any unforeseen problems when a driver maybe can't react because of the way in which a bit of the car is positioned. But yeah, so it cost about 18 million. It does seem to be doing quite well, both in terms of revenue and profitability. Even after paying for it, AB Dynamics still has, I think you said 20 million of cash on a balance sheet at the end. It was down about a fifth, but there's still quite a lot there to play with. And when we spoke to the chief exec, Charles Ralph, he was talking about this giving the company optionality, either in terms of going out and acquiring again or in investing in some of the other new business lines.
Those new business lines, there's a lot of different things in development there. I mean, how easy is it to assess, when you're looking at a company like this, the risk or, the potential reward of all these various potential strings to its bow in future? They're all very much in keeping with the, the vehicle testing. So they're not, it's not like it's branching out into, video games or something, but
I suppose the one good thing for AB Dynamics, as we've just said, it's got cash on the balance sheet, so it's not borrowing either to invest or to acquire at the minute. So you're not worried as much about the return on capital. It does have a kind of margin dilutive effect. They had this business they started last year, ABD Solutions, where they are essentially building robots or systems that will be able to automatically drive massive off-road vehicles, whether it's in defence or mining. That business, as I said, started last year, so it was massively loss-making. Even in this period, through analysts from Liberum did some calculations and reckon it lost about 1 million, so it depressed the overall group margin slightly. But again, the chief executive argued that it's bringing in some revenue at the minute. I think they've got a contract with a Japanese industrial company, and they've been doing lots of demonstrations with the likes of the MOD to prove that these systems work. And he was talking about that being really the key challenge at the minute, that once you show these systems, getting the customer confidence to trust in a driverless system is kind of key to get them to contract negotiation stage, which is where he reckons they are now with this business. And he was talking about break even for it next year. And for AB Dynamics operates on fabulous kind of gross margins of around high 50s percentage wise. And he was saying that even this business long run is looking at a similar sort of margin between 50-60%.
Yeah. As you say, the margin's very good in the business. There's one thing to watch for, I suppose, is the working capital arrangements with businesses like this, where you probably need a decent amount of inventory. You're going to have payables and receivables depending on all these different contracts that are being worked through. And also, in a lot of cases, given you're working with robots and new systems, they take a long time to build a lot of these robots as well. So there's going to be some lumpiness there. Those figures all seem okay at the moment. I mean, I suppose we should turn to the main part of the business is still the track testing part of the business,
which is about 70% of the business in terms of revenue at the moment. And there's still some decent fundamental drivers, if you would, there as well. There's the voluntary system they have for manufacturers testing new cars. Euro NCAP's had quite a lot of updates recently. There is a new roadmap to 2030 system that came out in November last year, I think, where testing standards are getting a complete overhaul. There's new testing being brought in for things like automated driver support or assisted driving, or the assessment of some of the new tech that's being installed into vehicles, like Seeing Machines. Another AIM company has these systems that are put in driver cabs where, say, bus drivers, if they start to show signs of tiredness, it will reflect back to the company and I think they use that for pilots as well for seeing machines. But all of these or a lot of these systems are unproven. So these Euro NCAP want to put the safety standards in place to make sure that they are uniform across for all manufacturers. And there are other things as well that were in there, like I know there was a book written last year by Caroline Criado Perez about how crash tests don't account for women's physiology and it's all based around men. So the new standards will try to reflect that as well and try to incorporate different body sizes for people who maybe are older and weaker as well. All of those tests, I mean, the company should really benefit from it. That and the fact that there's new Euro NCAP regime being rolled out for trucks, and AB Dynamics has these huge platforms which they stick cars on when they're testing suspension and steering, etc. And the chief exec Charles Ralph says that their system can easily handle trucks as well, anything up to 40 tons.
I mean, this is definitely a growth area, as you say. Although those developments, those platforms, I think, was AB Dynamics' original innovation. I think all the way back, whenever it was, 25 years ago or so, and clearly still going strong. Mark, what are your thoughts on AB Dynamics? As I said, it has been a popular AIM stock in the past and is on a decent run again at the moment.
Well, yeah, I think before you were referring to competitive moats, and I think what's worth considering in AB Dynamics as well is the difficulty it would be to replicate that business model because it is based on years of experience, years of data management as well. It was an incredibly popular stock with our readers at one stage as well, and I think these results, judging by Michael's comments as well, it sort of justifies their faith in the company. I think. What happens in the future, because it will be interesting. Michael just alluded there to autonomous features in automobiles, and AB will have to react to that. I would think, given the changes underway in the automotive market generally, they're going to have no shortage of business going forward, but there may well be sort of higher capital demands as well. So definitely one to watch as part of that wider supply chain in the sector.
It's also, as Mark said, it's a very popular stock. It's also kind of very highly rated as well, so there's maybe a little less room for error.
I'm still thinking about your comment about seeing machines and those services for pilots, making sure they don't fall asleep. I think that's raising more questions than it answers for me. Anyway, we'll move swiftly on. A final segment this week is on London Stock Exchange, which had a trading update out today as we record Thursday. Julian, this is a company you've covered for quite a long time. Again, a common theme this week. The trading update, fairly decent, and the business, which has obviously been trying to integrate the Refinitiv acquisition of a few years ago, that big deal, seems to be making some progress now, finally.
Yes, we're a very long way from the point where London Stock Exchange was our best performing sell tip in 2021. It basically, in the intervening time, they've integrated Refinitiv and they've spent quite a lot of money refreshing that platform. Anyone who's used Icon versus Bloomberg will generally prefer to use Bloomberg, but they're making a big effort to improve and expand that program. And the way that they're going to do it really is because the LSE has the market data that it can sell then to banks and other financial institutions. The trading update today showed that they're having some success in shifting kind of bundles of subscriptions to people and getting them to retain their presence. They've more or less finished the integration, and they're not spending any more capex than they've already flagged, which was a big issue that investors had at the start of the takeover deal. They end up having to spend more than they thought for slightly fewer savings than most people were expecting. But that seems to, the market seems to be putting that behind it, and the results are showing that Refinitiv is making some progress.
Yeah,
and that the LSE now is less dependent on being the kind of financial plumber for the markets and it seems to be successfully diversifying away from the risk that its core business is in gentle decline. So there's definite mood and note of optimism, I thought, in the trading update, and also in the way that the market's reacted over the last year or so. The shares, although they've range traded quite a lot, are looking a lot firmer than say this time last year.
Yeah, maybe we should just take a step back in that context and talk about the business of the London Stock Exchange nowadays, which is 20% nowadays of the business is capital markets, the LSE itself, AIM, bond trading platforms like Tradeweb, in which they have a stake, I think. 13% is post-trade, so kind of the clearing houses and things like that. But 2/3 now is this data and analytics business, which, as you say, even though it's probably never going to compete with Bloomberg successfully on Bloomberg's terms, it is something that can be sold into banks and be integrated into systems. And they've got a deal with Microsoft now to potentially integrate some of that into Excel, and which should help smooth those kind of sales a bit more, I think.
Yeah, it'll definitely make a big difference. I mean, we use, like in the same way that we use FactSet to generate our charts and data, using Icon in the same context would make life easier for everyone, probably.
Mm. You talk about the shares having range traded, and there is a potential catalyst for some improvement there as well, in that, as part of the Refinitiv deal, there was a lockup period for the likes of Thomson Reuters and Blackstone, the US investor as well, which has just expired, and there has been a placing, I think it was the start of last month, where they sold about 2 billion of LSE shares. So removing some of that overhang potentially could, potentially give the shares room for improved performance.
5% of the total stock. So yes, that's quite significant in the context of a market cap of that size. And I guess it gives LSE more freedom to buy back its own shares as well, so that there could be a double benefit there for investors, because the company does generate cash hand over fist, and a lot of that, I think, will end up in buybacks when it comes to supporting the underlying EPS.
Yeah, there has been an announcement of an intended buyback earlier this year, and maybe, because Thomson Reuters and Blackstone do still own some shares as well, maybe they'll buy back those shares directly too, but that does seem to be working its way through now. I suppose leading on from that, the question of valuation, on a surface level, it's not particularly cheap, or it doesn't look cheap compared with some businesses, PE of 20 that's a forward PE for 2024, but when you look at this kind of data business, that is relatively attractive. I think that the peer group, according to some brokers, is around 28 times 2024 earnings. So there's some potential there as well for them to close that gap as data becomes a bigger part of the business and as that deal is fully bedded in.
Yeah, it seems to be something they discovered by accident. I mean, that traditionally the exchanges didn't really bother with the financial data they generated, but obviously now that we've discovered the value of that, that gap should close quite significantly, actually, I think, in the years ahead. But it'll depend on the business mix as well, whether its underlying business in the market stays relatively stable, or whether data takes up more of the slack, as that sort of seems to be gradually declining.
Mark, any thoughts on LSE?
Just that it was I thought, a really encouraging set of results. I think they boosted the total income by about 15% to over £2 billion now. And you've got to remember as well that result was achieved when primary and secondary markets have been in severe decline. So hopefully, when the day returns, where listings pick up in London and the secondary market too, the Refinitiv deal might actually become even more obvious in a sense.
On that positive note, we're going to end the show. So thank you very much to Mark and to Julian and to Mike and to Arthur and to you for listening. We will be back next week with another Companies and Markets show.